Let me say this slowly so it lands properly. Not every profit you make is taxable. And under the new tax reform, some of the biggest profits are now completely tax-free. But if you don't understand this, you will keep on paying taxes you do not owe legally. Here comes our third lesson: capital gain tax, CGT. Capital gain tax is the tax charged on profits made from selling assets such as property, shares, vehicles, and valuable personal items. Historically, most people assume if I sell anything and make profits, I must pay CGT. That belief is outdated and very, very expensive. The new law clearly defines what the government will not tax. This is not guesswork. This is something that is written into law. So let's break this down. These are the exemptions that you must know. 1. Sales of an owner-occupied house. If you sell the house that you personally live in, not an investment property, there is no capital gain tax, regardless of how much the property appreciated. And the key insight is this: the law rewards ownership and use, not speculation. So if it is your primary residence, where you're living, the profit is yours. The second one is personal effects or chattels, up to 5 million naira. Personal items such as household furniture, personal electronics, non-commercial personal assets. If the total value is 5 million naira or less, CGT, that is capital gain tax, does not apply. And where people make mistake is that they incorrectly classify personal items as business assets, and this absolutely creates tax problems for themselves. Documentation really matters. The third one is sale of a private vehicles, up to 2 per year. You can sell up to 2 private vehicles in 1 year without paying CGT, that is the capital gain tax. Once it becomes frequent, or it becomes commercial, or becomes structured like a business, the exemption disappears. So intent matters, frequency matters, and records also matter. The fourth one is share sales below the threshold. You are exempt from CGT if total gains on shares are below 150 million naira per year, or gains that do not exceed 10 million naira. So this is a massive one for every startup founders, retail investors, employees with equity or share options. So the law is not encouraging. The law is encouraging investment participation and not punishing it. Capital gains tax does not apply to pension funds, charities, or any religious institutions, as long as activities are non-commercial. The moment profit making enters, the protection ends. So if you cannot prove ownership type, purpose of the asset, or whether it was personal or commercial, what you did with the proceeds and every other thing, you will still pay tax, even when the law tells you not to. So this is where documentation and proper structuring comes in, because capital gain tax is not triggered by profit alone. It is triggered by poor structure, weak records, and even wrong assumptions. So those who understand this will preserve their wealth, and those who do not will keep on paying tax that were never meant to be paid. All right, so if you own assets, or you invest, or plan to scale, this series is absolutely very, very compulsory for you. And in our next video, we'll be talking about company income tax, while some companies pay less and why some still pay more. Thank you very much, and that will be all for this series. We'll see you in our next series. If you are not yet be following us on our YouTube, Instagram, or TikTok, please do so with the handle emydigital network, EMY Digital Network. Thank you very much, and I'll see you in our next series. Bye bye.